TV, camping out.
There we go. Good afternoon, everybody. Joe Lucey here, and we have a special guest this week, Tom Siomades. He is the Chief Investment Officer with a partner of ours, Advisors Excel Wealth Management. Tom, thanks for joining us this afternoon.
Oh, thanks for having me on, Joe. I appreciate it.
So here's what we'll do here on this week's Market Huddle. It's October 5th. This year has just been cruising along with everything else going on. At times it seems like it's a very slow year, and then all of a sudden we're in October and colors are changing and everything else. But this week, Tom, what I wanted to do is I wanted to bring Tom on, talk a little bit about what we've seen over the last 90 days, talk a little bit about forecasting, a little bit about the future. Keep in mind, those of you that have joined us on these market huddles on a weekly basis know that we always have this disclaimer here. I'm not a certified public accountant. I'm not an attorney. I don't think we're going to get too much into the legal or the tax issues here today. But keep in mind that we are going to be talking about some forward-looking statements. They may or may not come fully through fruition, and don't take anything that we say here on this week's Market Huddle as promises of returns or anything like that. So with that said, I'm excited that we have Tom here. And what we'll do here today is he'll talk a little bit about what we've seen in the past, talk a little bit about forecasting, and then I think we might have a little bit of time for some Q&A, but I do know that we have a hard stop on Tom's end here. So with that said, without further ado, Tom, welcome.
Well, thanks, Joe. I appreciate it. And good morning. Well, it's noon, right? So I guess it's afternoon. Yeah. At this point, I'm down in the Kansas City area, so we're in the same time zone at least. But okay, let's skip the picture because I'm not one for vanity. I've been doing this for probably 30 years, since 1989, and I've had various roles from portfolio manager to analyst to research, head of a research department, to managing funds, to trading. So I've got a very, very, very diverse background when it comes to investments. And, there's never a dull moment when it comes to investments. And what I like about it is that one of the things that I got to do at my current role is there was always an opportunity for folks that wanted to kind of pigeonhole me. They wanted to say, well, you should be a portfolio manager or trader, or you should run research department, yada, yada, yada. And in my view, I like doing all those things. And what's great is that I get to do this in my current role, and I get to work with folks like Joe who, come up with solutions. I mean, at the end of the day, investments, like anything, is a solutions-based business. Everyone has different needs that they bring to the table. The important thing is to build a team around you that helps you achieve those goals, and to have the most talented, versed players that you can to bring is hugely. It's almost as important as whatever goal you're trying to achieve. So what I love about this is I get to talk to clients, I get to talk to advisors. I get to run my own portfolios. I get to talk to some of the smartest folks in the business, and hopefully some of that rubs off. But at the end of the day, it's important, I think, because besides your health and your family, really, I think your financial well-being is one of the most important things that you can invest in. And having folks like a trusted advisor, somebody like Joe, for example, I don't really look at them as just a finance guy per se or an investment guy. I look at them as my financial healthcare professional. And that's someone who can actually get you on your way. And, we all have busy lives, right? And especially everyone has different, situations that they're trying to solve for. And everybody's, stuff is unique. So, sometimes you may be very, very smart at what you do, but you don't have the time to devote to this. And so you need to be honest with your advisor. Tell them what your goals are. Don't worry about the semantics or the vocabulary or whether you sound smart saying what it is that you want. That's his job. His job is to sort of translate whatever it is you're telling them and then align the appropriate strategy and products to make that happen. So we've been in the KC area for a couple of years. I've got a I've been married for 33 years. My daughter's 19, is a sophomore at Penn State, and my son is a junior in high school. And for those that have had 16-year-old boys, I'm going to stop there, and I'll let you just kind of, look back into your past, and, you'll know exactly how we're feeling these days. A lot of testosterone, not a lot of common sense. That's all I'll say to that. Okay. So let's jump into what happened, in the last 90 days or so. So folks will remember we had, the onset of the coronavirus in the first quarter. The economy shut down, a pretty stark and hard stop. I mean, literally, I was on the road in mid-March. I came home on a Friday after doing client meetings, and Sunday my boss tells me don't come into the office because we're in essence locking down. Now, we were fortunate because we were deemed an essential business, and we had the what with all, just like I'm sure everyone's loving these sort of virtual things. I'm kind of sick of them at this point. I'd love to see people's faces, but we were well versed and well equipped to take advantage of this remote work. So that was a bit of a change for us. However, with a lot of businesses, it wasn't. I mean, if you're making cars, you can't make a car virtually. You can't, do dry cleaning virtually. So all these businesses were shut down, and factories were taken offline. And so, we had this immense deceleration as we ended the second quarter. And it wasn't until, April, early May, as that was coming to an end, that we started seeing the first sort of signs of a reopening. Obviously, the market tanked as a result. I mean, we had these like awful readings down into the end of March. But we were starting to recover. And, the hope initially was that the virus was going to be short-lived, and it was going to be we were going to make it through. We were going to lock down 14, 15 days. It was going to work its way through the system, and, we were all going to be back to normal. That didn't happen, obviously, given where we are today. Additionally, you also had the social unrest pop up as a result, and you folks up Minnesota way, probably were ground zero for that with the whole George Floyd thing. That mushroomed into a bigger sort of movement across the country. And so you had those two things basically going on simultaneously, right? So you had a country that was locked down and anxious, and then you had all of this social unrest going on top of it, which added to that anxiety. That said, the market is always a forward-looking mechanism. So think of it in the respects that they're not looking at what's happening today, they're looking at the future. And the market said, listen, we're not going to stay locked down for long. We will find a vaccine to this virus, eventually. There'll be better treatment, et cetera, et cetera. So the market started, ramping up the beginning of I would say June. And it continued to do that over the past 90 days or so into, September, I'll talk about in a second, but all the way through August. I mean, we got everything back that we lost during the coronavirus. We actually set new records on the S&P 500 and the NASDAQ. The Dow, because I don't know, folks hear a lot about the Dow. It's often referenced, but it's not a very representative index. It only has 30 names. One of those names is Boeing, and Boeing had problems before coronavirus and before the social unrest and before the lockdown, because of the airplane crashes and all those things. And, that's 1/30 of that index. Also energy, if you guys remember, we had this crazy volatile energy market because people weren't using oil. People weren't buying oil. People weren't driving and leaving their houses. So Chevron's another member of the Dow. So the Dow has been sort of hamstrung as far as its comeback is concerned. Now, we did get the CARES Act. Again, a lot of the 90-day stuff kind of transcends back and forth to the prior 90, because we got the CARES Act was started toward the end of the first quarter, and it actually got voted on in April. People started getting checks. There were some business protections, enhanced unemployment benefits, and all those things sort of, help fuel the market along with the Fed, which provided an immense amount of liquidity, driving interest rates down to nearly zero, which I hate to say it, but the term is TINA, right? The stock market, there really is no alternative. That was the only place where people can go and get any kind of return, because you weren't getting anything on your CDs, you weren't getting anything on, government bonds. And then that was effectively what the Fed did, was they flooded the market with liquidity. And the only place you could really go to find any kind of return was the stock market, which was rebounding. So the first quarter, we were down 4.7% on GDP. They finally revised the second quarter. We were down about 31.4%, which is horrendous, record setting. It was crazy. But as soon as we started reopening again, it was interesting, because once the reopening started, all these horrible records that you had on the negative side all of a sudden became these records on the positive side that we've never seen before. I mean, the first week the first month when we reopened, something like 5 million jobs were created. Now, those weren't really jobs that were created. Those were people that just were going back to work. So, that started the ball rolling on a super third quarter. September, which tends to be a very turbulent month, as I mentioned earlier, kind of, we were all a bit in September. But the interesting thing about that, a lot of that was begun to be driven by the fact that all of that CARES Act money was running out. They took the enhanced unemployment benefits away. And then Congress just started bickering. And, one group came up with like a $4 trillion plan that had everything in there from, funding on, failed pensions in states, and that had nothing to do with coronavirus. While the other side was like, hey, we just tossed $2 billion on the fire here, and now you guys want another $4 billion. At some point in time, you have to come to an understanding. So that September was sort of this month where we were trying to find clarity from Congress as to what they're going to do with respect to additional stimulus. As I said, the Fed's driven rates down to practically zero at this point. So it's not like we can look for the Fed to do anything else. I don't really see them going down the path of negative interest rates at this point. But, that's probably one of the few options they have left. And the Fed actually, Jerome Powell from the Fed actually came out a couple of weeks ago and said, listen, Congress needs to pass additional stimulus, which, it's an election year. So I don't understand what the hesitation is on the part of politicians, because I've never met one, regardless of party, that didn't like to give away free money. So that's been sort of baffling. And the only thing I could think of was the other thing that kind of roiled markets quite a bit in September was just kind of the nearness of the election, right? So now you've got this election that is supposed to be very contentious. Congress doesn't want to give the president a win. They want to make him look weak. At the same time, they're asking for anything and everything that they can get. So it's not a pretty situation. And then you start looking at policies, right? You look at the growth we've had. 2019, if you look at any of the numbers that came out from the census, was awesome as far as wage growth and unemployment and all those kind of things that we're probably beaten above the head and shoulders on the news every day. But the fact of it is, we're not in 2019. We're in 2020, which it's interesting. Joe was talking about the year sort of flying by, and I'm like thinking, it's kind of ironic that it's two identical numbers, 2020, because it feels like we keep having like a Groundhog's Day of a year. It's like it just keeps repeating itself. So those were the things over the last 90 days that had the biggest impact on markets. I mean, you start looking at the policies that are proposed on one side versus the continuation of policies. I mean, markets needed to parse that. They didn't understand how you would process a $4 trillion tax increase, or what the Green New Deal potentially would mean to existing industries. So, as the election got near, and that's something that we could talk about, going forward, that is probably going to be one of the biggest determinants in what happens in the markets in the fourth quarter. Is like, we just need to know what the policies are. I'm not necessarily making a call one way or another, but at the end of the day, you have to step back and get personalities out of it and not be emotional when you invest. So one of the things that the market does not like is uncertainty. So do you get a continuation of Trump policies, less regulation, more pro-business, or do you get a different vision that Joe Biden's proposing? I don't know, but neither does the market. So that's the real challenge going forward. The other issue has been, frankly, as we've reopened, you look at different parts of the country, some have been really, really slow in reopening. And there's some cynicism there where people may feel that they're potentially holding back reopening to try to just create more mayhem and, you know, not get us back to normal. Because if we get back to normal, people are going to say, look, you know what, why do I want to change horses in the middle of a stream when I'm sort of, you know, kind of good with where we are. But if you keep things stirred up, if you keep things, you know, streets, people locked up, people being, you know, tasered because they weren't wearing a mask at a middle school game, that keeps people anxious. And I think the market's the same way. They just want clarity. I mean, the market can deal with whatever the government throws at it. The problem is it just needs to know what the rules of the game are. Are we playing on a 100-yard field or a 1,000-yard field? And the market will figure out its way. So that is something that kind of spilled over from, you know, September into October, although October has been pretty good. Obviously, you know, the news of President Trump coming down with coronavirus, I don't know, it was pretty ugly in the futures market when I was watching those overnight. But then all of a sudden, you know, we ended the day fairly benign. So obviously, the market felt that wasn't going to be a risk. The other major risk that I potentially see out there is that all of this stuff that's been done with respect to mail-in balloting and the potential for a contested election. The problem I see it is President Trump's done a really good job of convincing Republicans that the mail-in is not going to be valid. So what I see happening, again, my opinion, you know, you may disagree, you may hear different, but my opinion is this. I think Republicans are going to show up at the polls and vote, and Trump will have a victory on election night. The problem is after the fact when the mail-in stuff starts coming in, and then it's going to start looking sort of shady because you start getting the lawyers involved. And it's kind of like, you know, in football when they make a call and then it goes up to the booth and it has to be indisputable. So that's going to be the real issue. It's going to be a booth review with respect to this election, and that's going to make markets sort of testy, especially in November as we head into the holiday season. The good thing about all of this, when you think back on it, look, we were in a pretty strong place in January and February, so we had a really solid foundation on which to build on. I think the market, you know, and so does the economy, doesn't have that long-term a memory, so they're preponderance is to go back to where we were. And at the end of the day, you know, the market and the economy is pushing to the upside, which I think will help, but it's not going to help if we have an election crisis in essence, where one party isn't going to give up. You got a bunch of lawyers that are involved, and, you know, that result is up in the air. So I think the upcoming quarter, and we just started it last week, so, you know, it's pretty much all of it's ahead of us, is the consumer is still really strong. I think there'll be a lot of, you know, spending come the holiday season, albeit differently. I think we're all doing things a little differently. But, you know, at the same time, I think, you know, all those type of things, the typical holiday stuff will happen. It's just it won't be in person or it'll be online. So those are the type of companies that'll benefit, you know, stuff that you could do online, stuff that you can do from home. But at the same time, I think November is going to be very volatile if you have all of this election fracas going on. And it's going to be challenging because, you know, the advice, and usually the first thing that people ask me, well, what should I do? Should I go to cash? Should I do this? Should I do that? So listen, if you're in this thing for the long term, this is going to be a blip. All right. This is eventually going to work itself out. The most important thing I could say to people is that we got a golden opportunity after March with the market coming back the way it did by August for you to sit there and think about, is this truly my risk profile that I'm comfortable with? If you were upset and uncomfortable, you're probably in too risky a portfolio. So again, this is where we get back to folks like Joe, where you could sit down and you don't have to sit around and talk about, you know, upside, downside capture or things along those lines. You just need to sit there and tell them, listen, when the market was down the toilet and was down 30% in March, I was really nervous. I could not sleep at night. I couldn't, you know, I couldn't bear to watch the news because I was anxious. Okay, that should be code for him to tell you, well, listen, we need to look at your risk tolerance because you shouldn't be having that kind of experience. Investments, in my view, should not be the topic of your conversation. Those should be the topics of your conversations are the things that you want to do with your investments when you've earned, when you've reached and earned your goals, right? Investments should be boring and predictable, and they should not be a huge cause of stress for you. So I would say the biggest thing I would say is at this point is we've had a golden opportunity, like I said, to get back to where we were. So here's a chance to reevaluate your risk and see if you're comfortable. If you're okay with it, I would just let it ride. You don't need it for another 2, 3, 5 years. This is going to be a blip along the way. But if you're needing your money soon, or you're just that uncomfortable, I would get with Joe and work it out and change your risk tolerance. Now, mind you, you're not going to get as high a return because you're not exposing yourself to as much risk, but you're also not going to lose to the extent that it's going to cause a lot of stress for you. So I don't know if I talked too much, Joe, not enough, if there's any specifics, but I'm happy to go back and forth and answer questions and whatever folks need to do.
No, I think that this has been great. I really appreciate some time here. A couple things that I wanted to make sure that we talked about. And John, I see we got a couple questions here from John and such, so we'll address those in just a second. But before I do, a couple headlines, a couple things that are going on internally in the office here. Many of you are aware that we're going to be moving offices. We should have that accomplished here on October 16th. The plan right now is that we will probably we have some movers coming in for some equipment like between 3 and 5 on the 15th, and then on the 16th, which is a Friday, we'll probably have more limited access. So with that said, we plan on being able to be here for you. We'll have access to our phones. Everybody here through the COVID, one thing that we all learned how to do is act and work remotely. So everybody here, even if we don't have a physical office space, we can still work from home and such while the movers are going on. We will be fully functional, though, by Saturday the 17th and back in action, and everybody's going to see changes around the new office space. One of the exciting things about the new space is that our technology that we're investing in, having the ability to stream presentations. We're going to be going back to lunch and learns fairly soon, I hope, where we'll be able to stream those. I know that Wendy Matthews is going to like this, but we're going to be able to do the lunch and learns where we can watch them live streamed. So if you don't have time to get away from the office, we found that these Monday huddles have been extremely popular. And we're going to bring that in with the lunch and learns, bring in another guest and what have you. So, John, we are moving from 5775 Wayzata Boulevard in St. Louis Park. We're going about 1.5 miles south of here. It's going to be 6121 Excelsior Boulevard. And there's going to be more information on that. I know that some of you are currently clients, and I also know that a lot of you might be attending this presentation for the first time because maybe somebody, one of our clients referred you to us. So we're going to make sure that we get that information out. If you are not in our database, if you want to send us an email at info@securedretirements, we'll make sure we add you to our information. You're going to get more about the move and what have you there. With that said, I wanted to also talk about what Tom had said about the importance of addressing risk and risk tolerance. Keep in mind, I think that there's 3 risks. There's risk capacity. How much can you lose and not have to change your retirement lifestyle? There's also risk required, the risk that you sit on that you don't get enough return to keep up with inflation, and then risk tolerance. Risk tolerance is this period of time where we might see market volatility where we are losing sleep at night. We have a couple different ways that we can address that with clients, and most of you I know have already gone through our process, our portfolio EKG. It's a stress test of your finances to make sure we've got the right risk for you. But I think Tom brought up a really good point. It's a good time to revisit this. So let's do this. I'm going to offer, again, our portfolio EKG, which is included in the tax smart retirement analysis. So whether you're a client, a prospective, somebody that's maybe been sitting in on these and have not stepped forward and asked for a visit, or if you maybe are getting this for the very first time, feel free to schedule a 15 to 30-minute phone call. We can address the risk. We can look at your portfolios, and meet either virtually or face-to-face if that's so warranted too. But the goal of this is always to make sure that we're addressing the number one action step you can take right now, which could very well be adjusting the risk in your portfolio. As Tom said, maybe we should go to raise some cash. Maybe we should be looking for longer-term investments that are going to protect principal. Or, personally, I'm plan on, because I have the money that we need for obligations set aside. My money is probably going to go up and down if the market does go up and down. So that's personally what we're doing. With that said, I know that we have a few minutes here. To Tom, I usually look at the Dow, NASDAQ, S&P, the VIX, the volatility index. Which index is the best indicator of the overall health of the market? I'll pass that on to you, Tom. What is the best index? If I'm looking at indexes, which is really the best that we should be keeping on our radar? I know in the office here, we oftentimes are looking at the Russell 3000 or the the Russell 1000. But what do you think is one of the better indices that we should be keeping our eye on to see the overall health of the market?
Yes. So the Russell 3000 I like because it not only has large names, it has small names, so it has a wider breadth. I would be leery of the NASDAQ, for example, because that's very tech laden. And although tech has been sort of the darling of the markets in recent times, it's misleading for the same reasons that I talked about the Dow. If that said, not a lot of people invest across the board, the entire market, unless they've sat down and done a robust asset allocation. And most folks, especially when it comes to guys that are doing their own thing in 401k and things like that, are looking at the S&P 500. So I would say the Russell 3000 is probably a very good, broad, healthy view of the market. I mean, if you really want to get crazy, you could look at like the Wilshire 5000, but that's not very ubiquitous. But I would say the Russell 3000 is a good one. So good for you for looking at that one, Joe. But I'd also think the more relevant one on a daily basis as well is if you're going to look at something every day, it's going to be the S&P 500. Probably
the easiest to access too. It's on the front of Yahoo Finance and what have you. Tim, what indice? Oh, I guess that was the same question I just answered. I'm sorry. Any other questions out there? I know that a lot of times the questions we have already been addressed. What should I be doing with the market and what have you? Tom, what is the one area outside of maybe the election that you think we need to be keeping on our radar to make sure that we are between now and maybe the end of the year that we should be thinking about? I know a lot of times, as we always say here at Secure Retirements, we're always looking to, number one, protect the cash flow, reduce taxes, and if we can, grow wealth. So wealth accumulation is usually not the primary goal of our clients. It's more becomes, if I can grow your wealth by protecting the income in retirement, that's the primary goal for most of our clients. But what are the other things that are kind of on the radar as far as what would maybe keep you up at night? Is there anything that you can think of?
Yes, so I think the propensity for people when they're seeing, now mind you, if you had to put event risk out there on a pie chart, I would say the election is probably going to take about 90% of that pie. The other problem is, so when people see that and they're like, wondering what's going to happen day to day, the bigger concern for folks at that point is that they tend to reach a state of inertia. They don't have a resolution, as in the case of the election, so they don't do anything else with anything else. And the problem is that if Congress gets a stimulus deal going, or there's other movement after the election, because now all of a sudden that event is passed and all you're left with is uncertainty. There's a lot of other things that are going to come into motion from a fiscal standpoint. The economy is going to print a mega number in the third quarter. So that's going to be impactful to the markets. And yet people will be out of the market and the thing will rocket. And I think what you've seen, Joe, you saw this in March. I mean, we literally fell off a cliff within a week or so. And by the same token, we could literally shoot up a cliff in the span of a week. And then people are just so fixated with, the hubbub of the day-to-day, the news or lack thereof, that they don't do anything with their portfolio. So that's why it's important. What you said, what you intimated earlier was that, look, let's figure out where you are and that you're positioned properly so you don't miss out on those things. That'd be my biggest concern. I don't think there's going to be anything by way of, new major deals or a conflict or anything like that. I just think that the election is going to be such a big item on the plate. We're just going to lose all the kernels and all the delicacies on the side of this, on the side dish.
And the other thing that I think that we have to keep in mind is that by the time the election gets, you had already talked about this, the market likes certainty. By the time the election has already been decided, by the time that whether it's Joe Biden or a Donald Trump, by the time that's decided, the markets will probably already address that and be up. So if you're going to go into cash, keep in mind, we always have to remember, you got to be right twice. You got to be right by selling it off, and then you have to be right by making sure you're buying it at a lower value. Because if you end up buying at a higher price or you miss the opportunity, a lot of times that's maybe could be a bigger loss. Long term, when I'm looking out over 10 years, 90-some% of the time, the markets outperform most other investments. As we bring it down to 5, they still has a pretty good track record. You start getting down to a year or so when the markets are more often up than down, but now I start looking at the next 3 months. The closer I bring that to today's date, a lot harder it is to predict the overall trend of the market. But longer term time horizons tend to work out well. Gary did bring up a point here. Gary's asking about the stimulus package and what should we expect if there's another stimulus package. I know I've also heard that there may be some additional PPP type PPP type funds that might be available for certain industries, maybe restaurants and what have you. Airlines is one. So what are your thoughts around a stimulus package 2 here that appears as if they're definitely been very likely going to see something passed here?
Yeah. So, they're about 600 billion apart, which, between, me and you, Joe, is a number that I can't even write, least of all. try to get my head around. But, I think at the end of the day, it's down to how much extra unemployment is provided, right? So that's, the Republicans are at 300, the Democrats are 600. They definitely are going to help the airlines because I know folks are paying attention, but last week they furloughed something like 32,000 people. I mean, it's an immense amount. And I know with Minneapolis, there's that big Northwest hub up there. So that's got to be painful too. So locally, but I think a lot of just the extra stuff that doesn't need to be there. And I think it'll end up being in there just to get the deal done. And I probably see it coming in somewhere around like 1.8. And there'll be small business protection and things along those lines. And those are all going to be good things. You were talking earlier about the market looking forward. And I don't know if folks know this, but if the market is up going into an election, the incumbent usually wins. I think it's like 87% of the other thing that I would tell folks, this election is very different. I think, we see polls and we see a lot of people screaming at the top of their lungs about who they want to support. And I think what's interesting, and there was a lot of stuff made about the debate last week and what a mess that was. What's interesting is that, what I'm finding as I talk to folks, very few people are actually outwardly talking about whether they support Donald Trump. There's a lot of people that say they don't like him and there's a lot of people that say they'd vote for Biden, but there's an immense silent group of people. And I'm sorry, at this point in time, this country's so divided that we know there's 40% on one side, 40% on the other. You can't tell me that there's literally 1 out of 5 people that still doesn't know who they're going to vote for. They're just not saying. So that adds to the anxiety and the confusion, because they come out with these crazy polls and say, oh, Biden's up by 15, right? Okay. But they were saying similar stuff back in 2016. And if there's a very real chance that you'll be abused physically or verbally when you go out in the street wearing a Trump shirt, odds are you're not going to say who you're voting for. So I think people have made up their mind. It's just really a question. The question down the road is going to be how are they going to count these votes? So you got 80 million votes out there, and you got a state that's razor thin, and all of a sudden they start coming back 80-20 for one side. People are going to start asking questions and saying, oh, wait a minute. If Ohio's 51-49, why are all the results coming back 9-1 for Trump or 8-2 for Biden? And those are the kind of things that are going to continue to just, sort of stir that pot, which is not a good thing for the market, I don't think. Shorter term. Longer term will be okay, but shorter term is going to create a lot of volatility.
Well, and so oftentimes just focusing on what we can control, things like future taxes. We know now with more stimulus, with the what's happened with the economy over the last since the first of the year with COVID, $3 trillion added to the national debt, more probably on the way. One thing that is certain that we can control is future taxes. We can't control the future tax, but we can control how we present or position our portfolios to address future taxes. And again, that's something that if you'd like to visit on this, whether you're an existing client or maybe joining us for the first time here today, you should still have an opportunity there where you can select that 15 to 30 minute strategy call and sit down with one of our team members here, or sit down either over the phone or face to face. Let's address your concerns. Let's make sure your planning's in place and making sure that the planning is still working for you. The last thing we want to do is talk about how we could see some things going on around the election and then choose not to do anything with our planning. So let's sit down and think that through. With that said, Tom, I know you had to run. I think I kept you a little longer than we had promised. I want to thank you for taking some time. You've been very generous with your time. And folks, we will bring Tom back on here in the future, talking about probably after the first of the year, or near the first of the year, we'll bring Tom back on, talking a little bit about what to expect about the markets in the first quarter of 2021. Can you believe it's only 3 months out? Anyways, with that said, everybody, I hope you have a great rest of your week, and I appreciate you joining us today. And again, feel free to set aside some time, request on the calendar there to visit with one of us. And without anything else, Tom, thank you again.
Yeah, thanks very much, Joe. Everybody be safe, and thanks again. Thanks for having me on. I appreciate it.
Have a great week, everybody. Bye-bye.
Take care.